Chasing quick profits. Why long-term investing is the key to building wealth. Hello and welcome. If you found yourself tempted by flashy promises of quick profits and overnight success in the stock market, you're not alone. Many beginner investors are drawn to the idea of striking it rich quickly. But here's the issue. Chasing quick profits isn't just risky, it's often a losing game. Instead, the real secret to building wealth lies in something far less glamorous but much more reliable: long-term investing. In this video, we'll break down why patience yields better results, how long-term strategies work, and how you, as a beginner, can start building wealth sustainably over time. Let's dive in. Let's start by talking about why so many people chase quick profits. Stock market trends, social media hype, and even stories of friends profiting off meme stocks or cryptocurrency booms make it seem like an easy way to get rich fast. As a result, you might feel tempted to dive into high-risk trades or speculative investments because they look like opportunities to double or triple your money overnight. But here's the problem. Chasing quick profits often leads to disappointment. The market is unpredictable in the short term, and these attempts not only increase your exposure to risk, but also make you vulnerable to emotional decision-making, like panic selling or overbuying during big swings. Statistically speaking, short-term speculation is a losing game for most investors. It's nearly impossible to time the market perfectly, and high-profile losses far outnumber the success stories you see in the media. For example, during speculative bubbles, people pour money into overinflated assets, only to watch prices crash, wiping out their savings. While daring moves can pay off occasionally, they often come with massive risks that most beginners aren't prepared for. Quick profit strategies also take a toll on your mental health. Constant monitoring of market trends, reacting emotionally to small fluctuations, and the intense pressure to make the right move are draining. Simply put, it's not a sustainable approach to growing wealth. So what's the alternative? Long-term investing. This strategy is as simple as it sounds, choosing wisely and holding on to investments for years, or even decades. Unlike speculative trading, long-term investing focuses on building steady growth through patience and discipline. The objective is to achieve meaningful financial goals like funding retirement, sending your kids to college, or gaining financial independence. Long-term investing isn't about chasing quick wins. Instead, it's about creating a portfolio filled with quality investments, such as index funds, stocks of established companies, or real estate, and allowing time to do the heavy lifting. Why is time such a powerful factor in investing? It all comes down to compounding. Compounding allows your money to grow exponentially. For example, the longer you keep an investment, the more time it has to accrue returns, not only on the original amount but also on the earnings. Picture a snowball rolling down a hill. It gathers more snow as it grows, increasing in size and speed. The stock market, historically, has tended to grow over time. Even with periods of volatility, such as recessions, markets have recovered and reached new highs. Long-term investors give themselves the chance to ride out market dips and actually benefit from cumulative growth during rebounds. Let's compare the two approaches. Short-term traders often rely on guesswork and timing the market, making them highly vulnerable to unpredictable swings. In contrast, long-term investors benefit from the overall rise of the markets over time, independent of any single day or month's movements. Historical data shows that holding investments for 10, 20, or 30 years can yield significantly higher returns compared to attempting to beat the market in the short term. Patience truly pays off when investing. Before we go further, let's debunk 3 common myths about long-term investing. It takes too long to see results. While long-term investing does require patience, small returns compound into impressive gains over time. Even slight progress in the early years exponentially increases later on. You need to be wealthy to start. Wrong. You can begin with small amounts and build gradually. Regular contributions make a huge difference. You'll miss out on quick wins. While it's true you won't benefit from sudden spikes, those spikes are often unpredictable, and chasing them can lead to bigger losses. Let's shift gears and talk about how beginner investors can start their journey into long-term investing. First, set clear investment goals. Ask yourself, why am I investing? What do I want to achieve in 10, 20, or 30 years? Your goals might include saving for retirement, buying a house, or creating a safety net. Next, determine your risk tolerance. As a beginner, you might prefer low-risk, beginner-friendly options like index funds or exchange-traded funds, ETFs. These provide diversification by spreading your money across many different companies and industries, lowering your risk exposure. Finally, choose an amount you can contribute regularly. Consistency is key in long-term investing. Whether it's $50 or $500 per month, making regular contributions ensures steady growth. It's impossible to overstate the importance of compounding. Let's look at a simple example. Imagine you invest $100 per month at an average 8% annual return. After 10 years, you'd have around $18,000. Not bad, right? But if you kept investing the same amount for 30 years, your total grows to approximately $150,000. This demonstrates the incredible benefit of starting early and staying consistent. The more time you give compounding to work, the more it transforms your modest contributions into significant wealth. One of the hardest parts of long-term investing is staying calm during market downturns. Falling stock prices might tempt you to sell your investments out of fear, thinking you're avoiding further loss. But here's the truth. Market dips are an inevitable part of the cycle, and they're often opportunities for long-term investors. A great example is the 2008 global financial crisis, where markets plummeted, causing widespread panic. But those who stayed invested or even bought more during the downturn reaped massive rewards when the markets recovered in subsequent years. The key to surviving volatility? Focus on the bigger picture and stick to your plan. Remember, it's the long-term growth that matters, not short-term fluctuations. Another essential part of long-term investing is reinvesting your returns to accelerate growth. For instance, reinvesting dividends or interest payments allows your money to compound further. Think of it as planting seeds. The more seeds you plant, the more trees you grow. Over time, this approach increases the size of your investment portfolio without requiring additional effort. It's a reliable way to boost your long-term success. A core principle of long-term investing is diversification, spreading your investments across different asset types, industries, and geographies to reduce risk. For example, instead of investing all your money in tech stocks, you could hold a mix of technology, healthcare, manufacturing, real estate, and other industries. If one sector underperforms, your other investments stabilize your portfolio. Diversification protects you from the ups and downs of any single market. A common pitfall for new investors is emotional investing, making decisions based on fear, greed, or FOMO, fear of missing out. This behavior leads to impulsive reactions, such as panic selling during market dips or jumping on trends without proper research. Long-term investors avoid this trap by sticking to their strategy and ignoring short-term noise. They know that consistency and discipline are far more important than reacting to every market movement. It's not enough to invest once. You need to form a solid investing habit. The easiest way? Automate your investments. Set up automatic contributions to your investment account so that you're consistently adding even during times you might feel uncertain. Automation removes emotions from the process and ensures you stay committed to your long-term plan. The earlier you start investing, the better your results will be. Why? Because time is the most valuable asset in investing. Even small contributions made early in life have more time to grow through compounding. For example, a 25-year-old who invests $200 per month for 40 years will likely have far more than a 40-year-old who invests $500 per month for 20 years, despite contributing less overall. Time truly is the magic ingredient in wealth building. Let's take some inspiration from one of the most famous long-term investors, Warren Buffett. He didn't build his immense wealth overnight. Instead, he started investing early, stayed patient, and allowed compounding to work its magic. The bulk of his wealth was amassed after decades of disciplined investing. These real-life examples prove that wealth isn't a matter of luck. It's the result of consistent effort, patience, and the power of time. The path to building wealth doesn't involve chasing quick profits or making reckless bets. Instead, it's about adopting the mindset of a long-term investor, focusing on quality investments, staying disciplined, and letting time do the hard work. It may not be the most exciting strategy, but it's a proven approach to reaching your goals, whether you're planning for retirement, saving for a major purchase, or creating a legacy for future generations. If you're ready to start your long-term investment journey, begin today. No contribution is too small and time is always on your side. Thank you for watching. If you found this video helpful, don't forget to like, subscribe, and share it with others seeking financial clarity. Until next time, stay patient and stay invested.